This recording is about the cost, volume, profit, income statement for Chapter 22. So Valero Company has sales in 2016 of $1.8 million on 60,000 units, and the variable costs are $720,000. Fixed costs are $510,000. And we're going to go ahead and put that into a cost, volume, profit, income statement, given that information. And then once we have that CVP done, we're going to create a second cost, volume, profit income statement with the following changes. So the changes that they're looking for is a decrease in the variable cost per unit. And so this is per unit of 20% or $2.40. The fixed operating costs are going to increase by $50,000. Management wants one half of that decline in variable cost to be passed on in the form of a sales price reduction, and the marketing department thinks that that sales price reduction is going to be resulting in a 10% increase in the number of units sold. So first thing, do not forget your heading. You do have to have the heading on these, so that will be points off if you do not put it in there. So they did give us that this was 60,000 units. They gave us the 1.8 million. You need to have one column that's the total, one column that is the per unit. You have to have this contribution margin line. If that's not in there, there's points off. So they gave us this. You need to calculate the per unit. They gave us the 720,000, so you can include this 60,000 times 12. You have to calculate the 12, or you can leave that detail off. It doesn't matter. It's got to be 60,000 units because if you're selling that many units, you have variable costs for that many units. This number, you should check that if this should be 60,000 times whatever you come up here, and it should work both ways. So this number, the 1.8, the 720, and the 510 were given to you, and you're calculating the rest. One thing that's important is that this net income number will be the same will be the same net income you would have if they gave you a net income before they gave you the cost broken out into variable and fixed. So if you had a net income before you put it into the CVP income statement, it should be the same net income. Now we're going to go ahead and we're going to put in the differences that they told us. So as far as additional information for doing the adjusted variable income statement, or CVP income statement, they told us that the raw material is going to have a 20% reduction. So there would be a decrease in the variable cost of $2.40. So the new variable cost will be $9.60. So when we go to the next screen, we're going to be using $9.60 for the variable cost instead of $12. They told us our fixed cost would be the $510,000, but it's going to increase by 50. So we have to add 50,000 to that. So we're going to have 560,000 instead of 510,000. Then they told us that our sales would be increasing by, our sales price, sorry. The sales price would be decreasing by half, 50% of this. So our sales price was $30, and we're going to decrease that by one half of the amount of the change in raw materials, so $1.20. So our sales price is going to be $28.80. And our unit sales, so marketing says that the number of units is going to increase by 10%. So our units is going to be 110% what it was in this period. So the number of units we're selling should be 66. Whoa, that's bad, 66,000 units. So when we go to the next page to do this, those numbers will be the basis. So what we see, we have sales, 66,000 units, $28.80. So we do that expansion. Variable costs, 66,000 units, per unit of $9.60. So we'll do that extension. Contribution margin, 2880 minus 960 gives us 1920. When we extend that, it's 1,267,200. Our fixed expenses increase to $560,000, so our net income goes to 707,200. So when we do a comparison and see whether this is something we want to do, we basically, on the prior version, we had net income of $570,000. So by undertaking this new raw material, our net income is going from $570,000 to $707,200. So it looks like it would be something that would be a good idea because we would be more profitable.